So can you describe maybe the basics of active versus passive? Again, if somebody's a beginner, they don't really know what we're talking about in that sense, because Bogle definitely played arguably the biggest role in this wide adoption of passive investing.
Yeah, I mean, simply put, if you think about the S&P 500 or the Russell 1000, these are indexes, and an index just tracks a group of stocks and it's weighted by the size of the stock. And that thing is sort of what we call market beta. It's just generally the market, and that's passive. So if you invest in a fund that holds the S&P 500 stocks, which are weighted by market cap, so Apple, Amazon are near the top, and then a company like, I don't know, something like Urban Outfitters would be near the bottom. They might not be in the S&P, so don't quote me on that, but you know what I mean? A smaller company would be towards the bottom. That's what passive is just buying the market. And what Bogle really, I think one of the big things he did is he now allows you to buy the market at no cost. So back in the day, there was no such thing as a cheap index fund. They had index funds. And when he introduced it, it was, I think, 45 basis points or 0.45% at first. And, you know, some people took it, but over the years, Vanguard lowered the fee. And so the reason there's a huge boom in passive investing really is because it's cheap. So owning the S&P 500 at 0.03% of an annual fee is a very compelling value proposition. The other thing is, over the years, it's just been proven that an active fund, which basically tries to beat the S&P by picking stocks and deviating from the benchmark, has largely underperformed. And if you go any given year, only about a third can outperform. But as you go along bigger time frames, like 10 years, 20 years, it whittles down to 10, 5%. And so a lot of investors are like, well, am I going to pay 80 basis points or 100 basis points a year for a 20 or 10% chance at outperforming? Or should I just lock in the market return for no cost? And almost everybody is picking the latter decision. But again, the no cost is where the Bogle effect really comes in, because Vanguard's structure is owned by the investors. So over the years, whenever they've gotten assets, the board, which is the investors, people who are elected by the investors, vote to lower the fees. So the fee of Vanguard's funds has gone from 40, 50 bips in 1975, 76, down to 3 or 4 for both stocks and bonds. And so this is massive, and it's caused a gigantic sea change. So really, I think passive is about just tracking an index, but for almost no cost. That's really what passive is. Active is thinking and trying to beat that index by picking stocks or bonds in a way that you think are, can outperform, but it's hard.
There's lots of flavors of it too, for sure.
Lots of flavors, yeah.
So how do you believe Jack Bogle? I thought it was interesting how you talked about some of the more personal things that happened to him. So he had a heart attack that you highlighted in the book, as well as dedication to his faith. So how do you think that shaped his journey in creating Vanguard? And maybe touch on like the ownership structure again, because
Sure.
We see a lot of DeFi and a lot of this focus on ownership of cryptos and everything. He kind of pioneered that already. It's kind of already a concept.
Absolutely. In the book, I say Bogle is really the OG of DeFi. It's not technically decentralized finance, but it's a good, pure, similar thing, because Bogle just removed a lot of your money from other people's pockets. And when you invest in a cheap index fund, you basically get to keep every cent. And that's in the spirit of DeFi, in my opinion. Now, the Vanguard mutual ownership structure is major. And this is why I wrote the book, because I felt index funds got too much credit for the index fund revolution. They're only popular because they're cheap. And they're only cheap because Bogle started a company where the funds own the company and the investors own the funds. Ipso facto, there's only the shareholders are the investors. And so, like I said, every time they get extra money, imagine if you were in a co-op and you have extra money, of course you're going to vote for your own self-interest. So the own self-interest of Vanguard's owners is to lower fees in the funds they are in, right? It's a beautiful thing, right? There are mutual ownership structures in the insurance industry that's a little more common there, but not in asset management. It makes no sense. And there's really no economic incentive to set up a company like this. Nobody goes to Wall Street to turn over all the future profits to the investors. That just, it's almost anti-capitalistic. The reason Bogle did it was he was a different kind of guy, but there was this really weird circumstance in the way he had a falling out with his partners in the 60s. If you read the book, you'll know what I'm talking about. So there was a circumstance that happened mixed with Bogle's just general abnormal mindset and populist attitude. And I think he was a natural fiduciary kind of guy. So he set up Vanguard as mutually owned. And then for the next 45 years, he pioneered the idea of low costs, and the costs went down and down and down. And the index fund was really a nice match made in heaven for that structure. Index funds were not invented by Bogle, but he definitely championed them. And the makeup of Bogle, I think you're right, because I interviewed 50 people and I asked them all the same question. Why has nobody copied Vanguard structure? And everybody said, because there's no economic incentive to do that. Well, then I said, well, then why did Bogle do it? And they all said the same thing. That's a good question. So chapter 4 is called Explaining Bogle, where I try to break down what went into somebody who would do this. Again, he created an $8 trillion company, and he, in assets, and he only ended up with a net worth of 80 million, which is a good amount for most people, but it's wouldn't even put him in the top 1,000 richest people on Wall Street. And so that is interesting to study. And I came up with a couple things. First, he grew up in the Great Depression. He was just one of those World War II types, like my grandmother, who saved everything and just didn't like to spend money, turned the lights off anytime they weren't in a room, that kind of mindset. He also had a huge experience in the 60s of thinking you should go and ride the growth wave, but then the whole market crashed. After that, he swore he would never take the bait again in a market cycle. And that's important, I think, because he just kept to this one strategy for 40 years. It's not easy. In markets, sometimes you get carried away. And you're like, oh, this is different now. And it never really is different. It's just these cycles. But he was able to stay the course through many cycles because of what he saw in the 60s. And I think his heart was another big one. He was told he wasn't going to live till past 35. He had a bad heart. So he went to the hospital constantly. When he played racquetball, he would have to bring a defibrillator with him. I think I butchered the pronunciation of that, but one of those things that gets your heart going again. And that's how near death he was his whole life. He even had a heart transplant later in life. So I think that gave him a jolt of life and purpose, knowing that death was nearby. And I do think he wasn't a religious fanatic at all, but he loved the Bible. He loved the stories of underdogs. And he always felt that if you do the right thing, God will get your back and, give you help. And the Bible is the most quoted book in all of his books. That's why I put that in there. So he also loved to read old poetry, history, and I think he saw himself as a sort of populist hero in his own story. And then, I think he was a guy who just didn't have a need for money, which is an odd pursuit. Most people go to Wall Street because they love money. He didn't have that gene. He did like the praise. He liked adulation and praise. And so being like the Saint Jack and the guy doing good for investors really suited his internal need for that praise. So like I said, he wasn't perfect. Everybody has different needs and things that drive them. I just feel like he was almost miscast in this industry. And I try to explain that in a way because, again, nobody's done this since. And it's just such an odd situation to have this company that is owned by the investors. And so it was interesting answering that question, but I feel like I got it as deep as I could with it. And I think people can learn from this guy. I think there's a lot of elements of him that speak to investors and young people today who are looking to make money, but also do good for the world. I think he was way ahead of that, because he did this during the Wall Street greed is good stuff. He did it during the Big Short in the 90s. I mean, he did it before it was kind of in vogue. Now I think it's a little more in vogue to have this sort of conscious business attitude. So I give him a lot of credit for being way ahead of that curve.
And if there's maybe one other thing that stood out to me, I'm going to butcher the statistic you put in there. It was something like 80% of the fund or the growth of the funds that he created wasn't for decades later. And so for a long time period, he was kind of pioneering his own trail, not really getting a lot of that credit and not getting that. Today, it's, Vanguard's a huge behemoth. It's a colossus, like you said. He didn't have that. He didn't know that was going to be that way, but he had the patience and the discipline to stick through his approach, whether it looked in vogue or not.
Yeah, that's a great point you bring up, and I stress that in the book. Listen to this stat. So if Vanguard has 8.3 trillion today, 97% of those assets came after he stepped down as CEO.
Wow.
Apple, I think 83% of their market cap is after Steve Jobs. So there is a pattern of people who are pioneers doesn't catch hold right away. They got to build this big foundation. And so, yeah, the patience, was incredible. The other thing that made it take a long time? Two things. One is he operated outside of that broker system I explained. At the time, the only way to sell a fund was to give broker money. He wouldn't do it. So he had to get people to leave the whole system, which is not easy. Means they have to leave their job and go out on their own. And that's scary. But he created a product so enticing that many brokers reformed themselves and became advisors, fiduciary, because they wanted to buy Vanguard funds. So he changed. That takes a while. The other thing is an index fund doesn't make intuitive sense. It does now, maybe today more so, but back in the day, it seemed like average. And in America, we like winners. And he had to really try to present all these other arguments for why it wasn't average, and over time, why you actually won. So all that took a lot of time. And then, but once the world turned and they kind of got it all, and the fiduciary movement had started, it was like an explosion. And obviously the assets went straight up like a hockey stick and continue to grow. They have grown by $1 trillion in the past 3 years, each year, like $1 trillion a year. It's crazy. And they've taken 1 billion a day. That's another reason I think we take it for granted, but those numbers are astonishing. But he saw barely any of it. In fact, he has a book where he has all his speeches from the 80s and 90s. And every Christmas party, his speech would be like, oh, we got 1 extra billion this year. We went from 7 billion to 8 billion. And he was so happy about that. Now they've taken $1 billion a day. That's crazy.